Okay, this is a review of Chapter 3, and again, we'll go over some of the review questions, not all of them, but some of them. So the first one asks, explain why auditors' reports are important to the users of financial statements and why it is desirable to have standard wording. So really the users of these financial statements are either banks or investors, and let's say it's investors especially. Investors are thinking, okay, maybe I have some extra money, or maybe I have a 401k and I want to invest in some different companies. You want to make sure that then you're looking at two different companies, that everything's apples to apples, so that you know, if I'm looking at audited financial statements of Tesla versus Amazon, that I can have faith that they both are following generally accepted accounting principles. There's no material misstatements, that. So again, that consistency, that standard wording, is important, and then especially the standard wording within the report itself, because again, it's an independent auditor's report. You want to make sure the people who prepare it are independent, and you want to make sure that the statements are presented fairly in all material respects, the financial position of the company. So those are some key words that are very important to investors and to lenders. Okay, then it asks about what are the purposes of the opinion section. Obviously, the opinion is going to tell you, is it a clean, good report, or is there like a significant issue that they're addressing? Is it an adverse opinion? Are they bad? Did they have to disclaim opinion because the client imposed scope restrictions or something like that? So the opinion is really the most important thing. And again, what everybody's looking for is that standard, unmodified opinion that is basically a clean report. Okay. So then it asks about what are the purposes of the auditor's responsibilities. So again, I always encourage you to read. There's a nice example of that standard unmodified opinion in the textbook. Read those. But the auditor's responsibilities are not to guarantee that the numbers have no errors or that they're completely free of fraud. The auditors are just giving reasonable assurance that the financial statements as a whole are free from material misstatement. So again, as a whole, and reasonable assurance is never a guarantee. Then it goes on to talk about they've used professional judgment and professional skepticism. They've identified and assessed the chances of risk of material misstatement. They've looked at their internal control structures. They've evaluated the appropriateness of the company's accounting policies, and then they've concluded that there's no significant issues that would make them believe that the company's going to be going under or not, or what they call it is a going concern. So those are all the auditor's responsibilities. And as you read through those, again, it's all very professional, but there's no guarantees. There's never any guarantees in audits that anything's, completely free of errors and all that type of stuff. Okay, then let's see, let's go. The circumstances for the standard unmodified opinion, which is what, number 5. So those are that all statements, so the balance sheet, income statements, the changes in stockholders' equity, and the statement of cash flows were all included, that they've gathered sufficient and appropriate evidence, and that the financial statements were presented fairly, again, in all material respects, in accordance with generally accepted accounting principles, and there was no circumstances that require an additional paragraph as an emphasis of matter. So those are the 4 things that have to be there for that standard unmodified report. Okay, then it asks us about that separate letter regarding the internal control structure. So the PCAOB does require that to, and again, it's a little bit different wording. I'll let you read over that letter, though, in the textbook. Okay, then when it talks about critical matters, And it asks us what does it ask us there? So 3.8, what is the rationale for the PCAOB's requirement to include a discussion of critical audit matters in the audit report? So those critical audit matters, again, are going to be key disclosure. So a disclosure of key audit matters that communicate to investors and the financial statements users. And they're going to be issues that are especially challenging, maybe very subjective, or have complex judgment that needs to be used to make those. So those are some examples though. So like if management had to make significant estimates or judgments when they prepared their financial statements, or if there was very large, unusual transactions that happened during that year, those would be two examples that would result in that, that critical audit matters paragraph. And sometimes those exist, so that could, and then again, it just provides that user with more information on what those could be. Okay, so let's see. Then we move on to an unmodified opinion with an emphasis of matter paragraph. Another example here that we have is if we're changing from like LIFO to FIFO. So number 11, so it says if the client changed from FIFO to LIFO inventory valuation in the current year and reflected its change in the financial statements, how would this be reflected? So when we have a change like that, it's going to affect the consistency, and that is going to require an explanatory paragraph in the opinion, in the auditor's opinion, again, assuming it was material. If it's just a minor and it's under a certain dollar amount, you would not have to have that separate paragraph. But in that case, it's a difference in consistency between one year to the next. And if it was material, it would have to be listed out or explained in a separate paragraph. And then that's kind of what 3.12 talks about, different changes that affect consistency versus those that affect comparability. So if it affects comparability, you don't have to have the paragraph. If it affects consistency, you do have to have the explanatory paragraph. So the one example was, again, changing accounting principles such as FIFO to LIFO or LIFO to FIFO. If there was a change in the reporting entity, such as a new additional company that's being added into those combined financial statements, or if it's a correction of errors where we're changing from an accounting principle that was not generally accepted accounting principles to GAAP. So if we're going from non-GAAP to GAAP. So those are things that are consistency and would have to have the paragraph. Things that are comparability would just be a change in estimates. So again, maybe it's like the life of an asset, we're depreciating it for longer or shorter. That would not require the paragraph. If it was just a mathematical error that we're correcting, again, nothing to do with generally accepted accounting principles, that would not have to be disclosed in a separate paragraph. And then if there was, like if we had new R&D or we sold a subsidiary, those are also things that we don't have. They affect comparability, but they don't require a separate paragraph. Okay, then the number 14, distinguish between a qualified opinion, an adverse opinion, and a disclaimer of an opinion, and circumstances that require, or examples that require that. So a qualified opinion can result as a limitation of the scope of the audit. So it's going to be used when the auditor concludes that the overall financial statements are fairly stated, but their scope was limited. So it's going to be more like an except for. So like everything else is clean. It was a clean report except for this one item that they were unable to get comfortable with. So examples again are if there's like a scope limitation and they are unable to like watch physical inventory being taken because they came in later after the fact. The adverse opinion is when they believe that the overall financial statements are materially misstated or misleading and they do not present fairly the financial positions of the company. So then that is bad. The adverse opinion is bad. And that is actually very uncommon because it would have to be either they've uncovered fraud, that the client was not working with them at all and they were unable to verify accounts and things like that. But so again, definitely like that's the least favorable opinion. And then a disclaimer of opinion is when the auditor has to not give an opinion. So they're unable to satisfy themselves that the financial statements are fairly presented, or they are not independent. If they come out and it believes that they are not independent, then they would have to issue a disclaimer. So then, so some examples again that are kind of common is like if there's a scope restriction, if it's immaterial, and the auditor could maybe use another alternative to verify inventory is accurate or to test the accounts receivable, they can issue a standard unmodified opinion. If they can't, then they could issue a qualified opinion and then make an except for. So except for the fact that we could not verify inventory or whatever that was. If they cannot get comfortable with it at all, they would have to do a disclaimer of opinion. Again, if the client restricted them from testing a certain area like inventory or accounts receivable. If they're not following generally accepted accounting principles, and it's a very immaterial thing, they could still issue their standard unmodified opinion. If it's more material but doesn't impact the whole statements, they could do that qualified opinion, which again has that except for, and they could explain the departure from GAAP. If it's so bad, like nothing's GAAP and the whole financial statements are off, then they'd have to do the adverse opinion. And then if they're not independent or somehow during the audit they discover they're not independent, they're going to have to do a disclaimer. So that's the most common one that gives a disclaimer. Okay, so I think we kind of covered some of the ones even below there where we talked about the departure or due to scope limitation. I answered those in that first question. Materiality, again, is another very important concept that is in this chapter because the auditors are looking at whether or not these statements present fairly in accordance with GAAP. So again, it's not 100% accurate. They're not saying I 100% know that these statements lack no errors or anything. So materiality comes in to say, well, what's our threshold? So if you're looking at a very huge company, normally we come up with a dollar amount threshold. So let's say anything below, $15,000 is immaterial to the overall financial statements. So then they might not really even test transactions that are more at that level. They could test processes that cover lower level transactions, but maybe when they're going to do their sampling, it could all be higher amounts. Or they're going to look at those accounts that are on the general ledger that have a much higher balance than ones, so maybe their supplies account has $5,000 in it. Well, they might not even care about supplies. That could be immaterial to them. So they're going to move on to say, well, we're going to look at raw material because that has $100,000 in it or whatever. So that amount is going to come into play with the materiality to determine what they test and what accounts they kind of focus on. And let's see, we talked already a little bit about how if it was a material, even if it was a non-GAAP thing, it has to be material for them to issue something other than an unmodified opinion. And we talked about the scope limitations already. Okay, so I think we covered pretty much everything that I wanted to in this review. And then there's no questions. Most of your problems and questions are assigned to you for homework. So I don't have any to go over here. All right, so that is it for chapter 3.